welcome you to today's webinar. Today we are going to discuss the margin requirements and compare that with option trading. The reason we are doing this and we are emphasizing this in webinar is to stress the fact that you don't need to be worried about the new margin requirements that is already in place, but will come almost close to 100% in the next couple of I think weeks. So you have been used to getting a margin exposure, which could be 3 times, 5 times on for intraday basis. Now what SEBI has done since last year is to gradually increase this over a period of 3 months, 25%, 50%, 75%, 100%. That means come August, you can only trade 1:1. The sense that if you have 1 lakh, you can put position which is equal to a margin amount of 1 lakh. So what does it imply? It implies that probably there is very little difference between a position trading and an intraday trade, because even in the past for position trading you need to put the span margin. If I am talking about FNBO, you need to put the span margin, you need to put the exposure margin. If you are taking in the cash market for position trading, if you are taking forward the position, then you needed to have the full amount of cash for what you bought. Now this is normal thing for the position trading or for investment. Now what's happened is it is the same thing. Only thing is that you need to have the money upfront. That is, only if you have the money in the morning when you put the trade, you can execute that particular trade. Now, so that means there is no difference between the previous position trading, and from now onwards, whether it's position or intraday trading, it's going to be the same. That means there is nothing like an intraday trading as far as money matter is concerned. Okay, as far as the requirement, capital requirement is concerned, there is going to be no difference between what is a position trading and what is intraday trading. Only difference that it can make is for intraday traders is you don't need to carry the risk of a position overnight. Suppose if you are already long today, then in that case you may fear that probably tomorrow something can happen, so I don't want to take forward those positions as far as the intraday trade is concerned or as far as the investment is concerned. So in those cases, that's the only difference that it's going to make, but otherwise you need to have the full capital at the time of initiating a trade. So now what we will do is that we will progressively see what is the margin requirement for a full position trading trade now, and what is it going to be in the next 1 month or so, and what is the amount that you need to invest in cash market, and what is the amount that you need to now look at the investment that is required in the case of an option trading or future trading, in whichever way we are going to look at it, and how you are going to overcome that problem. Because suppose if you had only 10,000 rupees a couple of months back, then probably you are able to trade Nifty intraday, right? Because there was 10,000 rupees was taken for us, because it is 75 quantity, so 150 rupees movement, and if the loss goes beyond that 10,000, that position used to get cut. Or for intraday traders, there used to be an alert around 3 o'clock to close the trade. So that sort of luxury may not be there now. So in a way, it's disadvantages, in a way it's advantageous. Disadvantage in the sense that probably you may have to put more capital. Advantage in the sense that you will be forced to trade in a proper manner. That is, there will be more prudential trading thing, so that you will be cutting off your risk substantially, but at the same time looking at ways to enhance your skill to make the positions profitable. So that is what we are going to see now. So let us look at first, we'll start with the cash market. Now suppose if you need to buy Reliance is going at 2,100 rupees, right? So you want to buy in the cash market, right, this one. So you need to pay 10 shares if you want to buy. So 21,000 rupees investment is required, right? So this 21,000 has to be there while doing the trade itself. So the amount, the system will check whether the amount is there in your system, then only can go for a buy in the next couple of weeks or so. Right now there is some amount of margin gap is still there. Maybe 75% of this may be required initially, and then 25% depending on whether you are going to carry forward the trade or not. So right now, coming weeks, you will need to have this much, the full amount of capital of 21,000 rupees is required if it's going to be cash market. Similarly, if you're buying Nifty Bs, no? So let us say now Nifty is around 15,700 range, right? So now the one contract in Nifty is 50 shares. So this may comes close to 7.5 lakhs plus. So if you need to buy in a cash market equivalent to this of 50 quantity, maybe in the Nifty Bs it may be trading at 157 rupees or 158 rupees or so. So we have to take the multiple quantity in that. So but I'm talking about if you want to invest 7.5 lakhs, so the equivalent amount of a one contract, then you need to have 7.5 lakhs in the cash market in your account to do the trade. So if it is going to be a cash market investment, I think we need to be clear that we need to put in our investment. So if it is going to cash market investment, okay, and it was there previously also, there's nothing to be afraid or worried about it, because even before also, if you're an investor, you need to have the money. That money might be at the end of the day. So how does it matter if the money is there in the 5 hours before? That. So you need to have your money well in advance without taking an exposure margin or something like that. That at the time of initiating the trade itself, you need to have the full amount of money. Okay. So it's a cash market investment. I think it's going to be the same like what you used to invest before. Only thing is full amount of money is required in the morning itself rather than by evening. Okay, so that's the difference. So you're not going to be, the status quo is not much change for an investor, whether he was doing it a couple of months back or right now. There is no change as far as the cash market investment is concerned. So the difference comes only in trading. So previously, what you used to do, suppose in a case of the same Reliance, for 21,000, probably if you were given 5 times, 6 times exposure, probably you might have had only 5,000 rupees in your account and could have traded this 10 shares in the morning, 21,000 rupees, and probably might have decided to cut or do whatever it is by the end of the day or at around 3 o'clock. So right now, you cannot do this, okay, or coming weeks you cannot do that. You need to keep this entire amount while doing the trade, okay. Now, how do you overcome this? Suppose if you say that I only have this 5,000 rupees capital, okay, I have only 5,000 rupees of capital, or let us say you have got 10,000 rupees of capital. Can I still probably look towards trading in Nifty Futures? Okay, now we'll come to the F&O side. Can I trade with 10,000 rupees in Nifty Futures? Now, if you look at the present exposure margin, it is not possible to trade Nifty Futures with 10,000 rupees in your account, because right now let us look at the margin requirement. First of all, for Nifty, now Nifty, now it's a 50 quantity lot, and the full margin money, which is the span plus exposure, because exposure margin is 2% of the trade, right? So it's 2%, and now this will be coming because of 7.5 lakhs. Probably this may be coming to 15,000 rupees or so. So the balance is all span. Balance is all span, and the total amount for doing 50 is approximately 1.10 lakhs. Approximately, I'm saying. Is now if you want to have a position in Nifty Futures, you need to have 1.1 lakhs as the margin money. In the case of Bank Nifty, it is a 25 lot quantity, right? So Bank Nifty, now you have got a 25. So here also approximately 35,000 into 25. This is the value of the contract. Now the margin money for this futures trading, now the same thing, 2% of this particular trade. So exposure margin is not going to make difference, because one lot is almost the same value of 7.5 lakhs. So the difference is going to come in the span margin because of the higher volatility. The total margin money that is required for one contract of futures trade is 1.65 lakhs. Is 1.65 lakhs, right? So this much of money is required, which means what is the entire intention of SEBI? One, and will they be still successful? That's the question. Now, of course, whatever that is in our interest, we need to take care of that. I'm not saying that over that. But suppose if they feel that because of hiking this margin exposure, they are likely to stop trading I think that is not going to happen. That's not going to happen, and traders can continue to do even much better, which we'll explain right now. Now, this 1.65 lakhs is the amount that is required as far as Bank Nifty is concerned. So, all this trade of Nifty Futures and Nifty Bank Nifty Futures, for those who cannot invest 1 lakh or 1.5 lakhs plus, okay, now will turn more towards of reducing this capital, and still is it possible? Now, what is the alternative to such a huge capital? The alternative, which we have already explained even previously, is options. Now, I told you the option whether you can trade with 10,000 rupees itself for the futures. Now, first of all, in this we need to classify ourselves as whether we are going to trade purely intraday. Why for this I will come to it later on. What difference it's going to make? Positional. Okay. So you need to look at whether you're going to do intraday or positional. Now, the reason why we are saying that intraday and positional we have to look differently at the options is because of the time value, volatility, all those factors which I have explained before. So, I am not going into those technicalities, but I am saying if it is going to be intraday, let us first solve the problem of an intraday trade. Now, intraday nowadays, so we look at the easiest is the weekly option, where there is very highly liquid, and also we will look at what is the at the money. Now, at the money means where a strike which is very closer to the present futures position. Okay, a strike which is very closer to the present futures position is called at the money. Is called at the money. Okay, so now in this, let us say now Nifty is trading for 15,680 or 690 levels. So tomorrow you want to do an intraday. Tomorrow is only Tuesday. So you want to do an intraday trade. Okay. So we will look at 15,700 strikes. So tomorrow morning, let us say you are getting a buy trigger. That is to buy Nifty Futures or buy Nifty. But for Nifty Futures, you need to pay 1.10 lakhs or approximately that, because now still the exposure is not 100%. So maybe less. But let us say in coming months, you need to pay 1.1 lakhs in order to initiate even an intraday trade as far as Nifty Futures is concerned. Now, 15,700, we have already explained to you that call buying is almost like a futures buying. That is, what are the alternatives to a futures buying? Alternative to futures buying is this. You buy a call, right? Say buy call spread, okay, in some quantity in ratio. 3, sell put for sell put spread. Okay. Now, the sell put we are eliminating because that will require almost the same margin like a futures. Maybe some difference will be there. So, we are removing this. Sell put, we are removing this. Okay. So, buy call spread, sell put spread. Now, we will come to this later on, which we explained as a strategy last Friday. Okay. Now, what we are looking at is whether can we look at buy call or sell put spread or buy call spread of deep in the money. So, it's going to be the same, but okay. So, buy call now for intraday. Okay. So, what we will do is that 15,000, let us say the market is Nifty is going to rally above 15,700. You want to buy a 15,700 call. Okay. So, you buy a 15,700 call. Now, what is the price and what is the quantity that you should do, which will come to be like a futures? This is purely an intraday trade. This is purely an intraday trade. Okay. So, let's look at this. We go to the NSE option side. So, 15,700 call for this week is approximately 70 rupees. Is going approximately at 70 rupees. Okay. So, let's look at now, go back. So, 70 rupees. So, how much you need to pay for the options premium? It is 70 into 50. 50 is lot. So, 3,500. This is the amount that you require for call option buying. But the amount of calls that you need to buy, that is the number of the quantity, it is instead of 50 is one lot. So what you should do is, in order to get a risk reward profile which is similar to the futures, because right now our entire intention is we want to get a reward which is like a futures, or a risk also which is futures. But what we want is, we want to save on the premium, we want to save on the capital. We want to save on the capital. As against 1.1 lakhs, we are looking at what is the minimal market amount that you can put, but at the same time reap the benefits of the futures trading. Now, this is one lot. You buy two lots of this. It will come to 7,000 rupees, right? Two lots. Now, here and there could be some play of volatility and some impact of volatility either on the positive or negative side. So let's forget about that. So two lots, you just buy, it will be approximately 7,000 rupees is what is going to be there. This is the amount of capital that you require, not 1.1 lakhs. This was there even before. Unfortunately, because of the lack of, I would say, interest in options, or probably lack of understanding, I would say, lack of understanding of options, this was not adopted. So because of the exposure margin that was available, then most of the traders used to avail of that exposure margin and not look at the options. So now the futures segment, entailing a great amount of this one, you are now forced to go into options. So SEBI in one way will be winning, because even though you may go with a lesser capital, I mean, like you can still trade, probably speculative traders will be there. Question for them is that the amount of loss they are going to have will be much limited compared to the futures. That's what they will be, because in a single day, if assuming the Nifty moves by more than 150 points, you will lose 7,000 rupees or approximately, right? But here the maximum loss is going to be only 7,000. So you cannot, because there, suppose the market just falls by 300 points, probably you lose more. But here you still lose less. You still lose less. So, or the maximum that you are going to lose is, to that extent, probably the amount of loss that a trader makes, a small trader makes, is still going to be limited. To that extent, probably SEBI as a case in order to reduce the exposure margin, or eliminate the exposure margin that was given as far as the intraday trade is concerned. So now you need to put in the full amount of capital or the full amount of premium that is required to be put. So this is the amount that probably you need to put in there. And so 7,000 rupees, with this you are going to trade the entire something like a Nifty Futures. So is it not really appealing? Is it not that because of such a reduced capital, is there anything to fear that probably because the reduction of the unavailability of margin is going to hurt your trading? The trading can be hurt because of certain fluctuations where we are not in a position to take a loss, psychological problem. That is a different issue. But regarding the capital thing, you don't need to be scared. You don't need to be worried. The capital that is required is far, far less, and it was like that even before. We were not using it. Right now, we are now forced to use options, mainly because of the otherwise requirement of the huge amount of money that is required as far as the futures is concerned. So you can trade even a little more safely in the case of buying a call option and doing this. Now, the same thing applies for Bank Nifty also. Bank Nifty, we said this one, that is the 1.65 lakhs. So let us look at what is the Bank Nifty call option right now at this place. So Bank Nifty, same thing for this particular week. Now Bank Nifty, let us say at the money option, which is 35,000, approximately 35,200, right? So 35,200 is going something like 245, that was 207. So let's say average is 225 rupees. Right now, tomorrow you are getting a Bank Nifty buy call, let us say. So you need to put in 225 rupees option premium, that into 25. Okay, Now this is approximately 4,225 rupees. So this is going to be 5,625. 5,625 and 2 lots of this in order to get something like a Bank Nifty Futures. So 565 into 2, it's 11,250. This is the amount of capital that is required and not 1.65 lakhs. Where is this? Where is this? It is just approximately not even 10% of this 16,500. It's only 6-7% of the requirement. Does it not mean that probably you are getting such a huge of 20 times of exposure margin approximately we are talking about, or 15 times or 16 times? So we don't need to really worry about that. No, suddenly there is something like, a vacuum, okay, and what you are used to it is being taken away from you. No, what has been what you are used to it may have been taken away, but it is being replaced by a much more healthy and much more lesser requirement of the capital. So you have got nothing to worry about trading as far as Nifty or Bank Nifty is concerned, and you will get a same type of reward by doing this. And another advantage for you is that now we are talking about intraday trade. So if I look at the positional trade, in fact, the positional trade, the only fear right now is that it's a question of risk, because what we said about distinction right now, that is previously it was between intraday trade and positional trade. So what was the difference at that time? The difference was, one is the capital. Okay. Capital difference was there. You needed more money here, much more less money. Second thing, the risk of carrying forward the trade, risk of carrying the trade. Right, risk of carrying the trade overnight. Okay. Now, generally speaking, the risk of carrying the trade probably works 50-50. Now, sometimes 50-50, no, even slightly more on the bullish side. Now, sometimes you get the upside also, right? So there is a gap up opening. Today also, if you see, Friday close was 15,687, and today it opened at 15,740 or 50, right? So there was a gap up opening today. So there was a benefit of that gap up opening. Okay. So it's not that every time the risk is only towards a gap down. That may happen only in some circumstances. So there are many circumstances where the gap up also is there. So I think the question is, it gets evened out over a period of time. So over a period of time, definitely some gap ups, some gap downs. Probably I think between the intraday and position trading, I don't think you're going to suffer much. So the risk of carrying the trade, I think to a very large extent is balanced by sometimes working very well for you, sometimes going against you. Now, only thing is that because previously when it used to go against you, you are quite afraid because of the futures trade that you used to take, because that can probably hit you much harder, right? Because it's an open position, and probably the fear will always be there whether it's going to go down and whether we should put a stop loss, and after putting the stop loss it's going to jump. So those problems used to be there. Now, that amount of problem to a large extent can be solved by going in for an option, because one is that we know that the option has a limited risk. Okay, now option has a limited risk in the sense that the premium amount is going to be the maximum loss, and next day if there is going to be a huge fall, if you are in a long position, probably you will be hurt more in the futures and less in the case of options. Okay, so that is going to happen. So the option will also save you as far as positional trading is concerned, provided there is a good amount of movement. Provided there is a good amount of movement when compared to the normal volatility. So if the volatility, if the movement is as good as the volatility implies, then probably the option will work. But today, if you look at it, it is a flat close. So compared to yesterday, suppose now let us say these are the circumstances where probably we may be hurt. For example, we'll go to the Nifty itself to give a better idea. So Nifty 15,700, Nifty was close to 15,700 on that day also. But if you see, you see a drop which is around 8 rupees, right? So 15,700, we have a drop of maybe 24 rupees on the call side and 8 rupees on the put side. So the amount of loss in the call side was much higher, and but that may be due to because the call option, the price was slightly on the higher side because of the carry forward premium as far as the futures also is concerned. So on average, we have lost both in the case of call and in case of put also. So this is the loss which becomes when the market is trading quite flat, right? So this is the problem as far as the flat trading is concerned. So this is the risk of carrying forward an option overnight position. This is the risk of carrying forward that. So what we need to do then in that particular case, we need to look at something which is which probably will be something then the time decay does not work against us. So what we need to do is we need to ensure that this problem of the time decay in the case of options does not work against us if we carry forward the trade. So in that particular case, we then need to go for the spread trade. So then in that case, we need to go for the spread trade. That is what we illustrated, and we have been illustrating, and we will continue to illustrate in order to get you a good handle of this particular thing. So the spread trade, we have said, is nothing but you need to have two legs. One leg is the sell side, and another leg, second leg, is the buy side. So let us say we are doing if you are getting a long call. Okay, now generally speaking, the market is on the upside right now. Say for example, let us go to the chart. So this is Nifty is concerned. So Nifty has been stagnating, consolidating, mainly between 15,620, 15,630 on the downside, and on the upside it's around 15,900. So it's more of a consolidation between 15.6 and 15.9. So in that particular event of this stagnation, then you will lose a lot on the option premium, because if it doesn't move much, then in that case you will lose. Okay, so that problem can be overcome by going in for a spread trade. So that spread trade, you are going to put it like this. One leg is the sell, another leg is going to be the buy. So you can choose now. The present position is 15,700. So the sell leg and buy leg, you can choose either way. Like now, for example, if you feel that the upside is going to be rather limited, not more than 50 rupees, 60 rupees, then that is the upside on the future side is going to be limited. Then you can put in a sell side, which is 15,700 sell, 15,700 put, and buy a 15,600 put, because right now the market is stagnating in this level, for which you will now receive a premium . 15,700 is 71 rupees, 15,600 is 34. So you will receive approximately, for this difference, you will receive something like 37 or 38 rupees, right? So doing a 15,700, 15,600 spread, right now you will get something like a 38 rupees is what probably you will get. Okay. So if you feel that the market is going to have a much greater movement on the upside, then in that case you don't need to do that. Just you just buy the futures right now itself, and just buy a 15,600 put for 34-35 rupees. So if it is going to be on the upside, I think your chances of you making much more money is going to be there. Okay, so that is one type of trade that probably you can look at it for as far as the this particular week also is concerned, because the chance that market can just goes up, goes down, goes up, goes down, and probably again it may go up to 15.8 or 15.9. So you can do this particular trade. Okay. Now the second type of trade that probably you can look at it is, because now let's look at the margin that is required for this. Now there will be a span plus exposure margin. okay, if you do this trade on any spread trade, okay, there will be for this you will have a margin which is the span plus exposure. Now, the exposure margin is always the 2%. So for this, approximately 15,000 will come. Okay, approximately 15,000 will come. The span is going to be the difference in the spread difference minus the premium that you are receiving. So the span difference in this case is 100 rupees, right? So 100 into 50, 5,000 rupees, minus you are receiving 38 rupees as a premium. So 38 into 50, approximately, let us say 1,900. So the span that will be required is 3,100. So you add this. So the amount of requirement that you require for this trade is 18,100. Is 18,100, right? So you can do this type of trade. Okay, you can do this type of trade for 18,100 rupees. Okay. So any spread trade for that matter. Okay. Once the risk is eliminated very significantly, then the amount of span margin comes down drastically. The amount of span margin that comes down is drastically, it comes down, and it enables you to do the trade much more confidently. So this type of trades probably will help you to get the time value on your side, because it will negate the time value, mainly because you are doing a spread trade, because one on the sell and buy side you are there. So sell side time value can knock off the buy time value, so you don't need to lose much of a time value, so you will gain out of that. Then second thing which we have already said is that you do the trade, keep it at a certain distance which is equivalent to 2 times the option price. Now 2 times option price means it's 70 into 2, 140 right now. So 140 rupees from 15,000 right now minus approximately 15,500. So the trade that you should do is 15,700, 15,500 looks to be a little safer trade. So you go for a sell of 15,500. At the same time, in order to reduce the margin, what you do is the difference here between this present spot and the sell side leg is 150 rupees. So the buy side you keep from the sell side 150 rupees. So 15,400. So you can adopt this particular trade of 15.5 to 15.4 trade. Approximately the same amount of margin will come, which we said 17, 18,000 or 20,000 rupees. And let's look at the premium for this. The premium that we are paying for this is 15.5 is 15 rupees only, and 15,400 is 6. So you're getting 9 to 10 rupees there. So of course it will look as if you're doing this trade without much this one. So probably you will receive only 10 rupees. Okay. But what the reason why we are doing this trade is, now it goes up, then okay, you get only 10 rupees or so. Okay. But you do this consistently, you will get the 10 rupees, because if Nifty is going to stagnate anywhere between 15.7 to 15.5 or 15.490, then still this option would have worked much better than having a futures. Okay. But only thing is, if the futures is going to go up, then this will be there. So it will all depend on the view that you take, how much of whether the futures has got a brighter chance or the spread has got a brighter chance. But if you do a futures, the capital required will be more. So even if you do this consistently, okay, you will have a win, or you will have the number of profit points over a period of time is going to be the same like doing a futures. That is what we have seen from our previous historical track records. So what you do is that you take a 15.5 and 15.4 and do this trade. But assuming not for some reason or other, Nifty Futures comes down to 15,500. Let us say it comes down to 15,500. That point of time, what you do is that because it has come down to that particular point, that time the sell side, you can convert that into the option on the buy side. That is, you can just close this particular trade. That is, you can think of closing this particular trade and going for futures buy, because from there the chances of you getting much more higher profit will come. Okay, much higher profit will come. That point of time, you just think about going for a futures buying if it comes down to that particular level, right? So this is this chance of this way of probably doing this trade is much better than looking only towards pure option buying, because pure option buying suffers from the possibility of a time decay. So you should work out to ensure that the time decay is not much. Okay, right now because of very low volatility, today we are getting a very low difference in the premium, 15,500 to 15,400. So the same strategy a couple of days back, which we illustrated on on Friday, for a Thursday trade itself, we did 15.5 and 15.3 and secured some 23-24 rupees. Right, so secured something like 23 to 24 rupees, and today I think it has even decayed much. Okay, so doing this particular trade, okay, entices you to get a good amount of option premium on your side, and over a period of time you are able to get a profit which is equal to the futures, by the same time deploying much lower capital. Now, so this type of trades, like what we suggested, could be considered. Then I told you that in case if you want to go for a positional trade, okay, for a positional trade, the time decay has to be kept in mind. That's why I told you that go for a sell spread contract and all. But if you feel that you're going to have a much higher profit than what the premium difference you're going to get in a spread option, then instead of going for the future still, you can go for buying a deep in the money option. Now, which I told you right now, we are at 15,700, right? So tomorrow you want to take a positional trade today, let us say. In this case, what you do is that you consider something like a 15,500 put or a 15,400 put, where you don't need to pay too much of a time value. So let us see what comes there. So call option for a 15,500, right now, see the time value that you'll be losing is 15 rupees for the next 2-3 days. And if you go for 15,400, you're going to lose only some 6 rupees or so. And that 6 rupees, if you want, you can if you pay a little bit of on the upside, then probably you can just close with 16,000. So what you can do is something like futures you want, okay. So and you want to pay some much lower span margin, much lower margin. Then in that case, what you do is that you go for a 15,400 call. There in that case, if you buy a 15,400 call and go for a 16,000, then in that case there won't be any span margin, there will be only an exposure margin, which would be only 15,000 plus 307 into 15,000. So for 30,000 rupees, you will get something for which you can do for something like a positional trade without suffering the disadvantage of doing an option buying. Because if you do an option buying, the question is that yes, you can do 2 contracts of this and pay 70 into 2, 150 into 50, you can do this even for 7,500 rupees or 7,500 rupees or so. So the capital required may be much lower. But in that particular case, you suffer a slightly bigger disadvantage of the premium eating you. So in that particular case, you better do a 15,400 call and sell a 16,000 call in order to reduce your this one. Or because even that 4 rupees, 5 rupees you don't mind paying, just pay a 15,500 call. This 4 rupees, 5 rupees, okay, fine, we will leave it there. So 4 rupees, 5 rupees, we will leave it there. So 305 rupees. So approximately if you do a 300 rupees, it's just going to come to into 50 is going to be 15,000 rupees without losing much on the time value. So for 15,000 rupees, you can do a futures position on the upside. Now, I told you that before this Thursday, general chances that the market can be above 15,650. So whenever it dropped closer to 15,650 or so, in that case you can go for a buy option, deep in the money option, and expect since the market to go up, then probably like yesterday, then the chances that it goes up by 50, 100 rupees or 150 rupees, chances of profit will be quite high. So you can do this without taking the worry of a higher capital. Second advantage is that if there is going to be some sort of a big problem, okay, overnight position, then even if the market is going to sink, at least you know that the maximum loss in this particular trade is going to be 15,000. So by rolling over that particular contract over a period of time, you are still going to make money. You are still going to make money in that. So you can be rest assured that you have got very less problem in your hand as far as the time value is concerned, as far as the deep loss is concerned, and probably getting a risk reward profile which is similar to the futures. So the entire point that we are trying to emphasize, the same thing, whatever I am telling you, we can do for Bank Nifty also. Now, so in the case of Bank Nifty, right now the amount of this one that you need to pay is 34,500 is approximately 770 rupees. So 770 into 25 is 15,000 rupees. So you can do something like if you still don't want to pay too much of a margin, because 36,500 is going to be not there much, so maybe you can pay this, you can sell this for 13 rupees or so. So the net amount, or probably you can feel that even 36,000 may not go through, then that 36,000 is around 35 rupees. So this is 35 and that is also 35, and so you don't you will have no time value difference, and you will get 34,500. 775 into 25 is only 15,000 rupees, and now the market is only 35,200 approximately. So 800 rupees for 2 days, I think mostly it can be only like that. So I think no, going by that present option premium, we don't expect it's going to be much more, about 35,700, 35,800. So you can definitely sell a 36,000 call and buy a 34,500 call. So that will entail something like, this will entail 775 rupees into 25 is 15,000 rupees. Probably you have the span and exposure margin also coming for you, which could be something like exposure margin will not be there, because of the span margin will not be there, because you are buying option which is deep in the money. So exposure, this one also only will come, exposure margin 15,000. So approximately for 30,000 rupees, you can do something like a futures instead of 1.65 lakhs. Instead of 1.65 lakhs. So what I'm trying to say is that over a period of time, when you get some money made out of futures, because the cash market always moves up, so when you get some money made out of the futures, because you've got a lesser amount of capital that is deployed, sure you're going to make a win. So for example, let us say the cash market gives you an annual return of 10%. Now 4% is going to go off in the margin, right? So 4% is going to go in the premium. Every month by the rollover premium, it's going to be approximately 4% or 5%. So if the cash market returns you 10%, so generally you will get 5% for the futures, okay? But 5% in the futures, okay, since that itself is leveraged, to the extent of maybe 5 times. So the return compared to spot market will be some 20-25%. But if you are putting much lower capital, 1/3 or 1/4, the return on the capital that you are going to put is going to be fantastic. It's going to be excellent. So what I'm suggesting is that we have got a general belief that the market is going to go up. Okay, general belief. Even if there is a fall, the market is going to go up. So what I suggest is you just go for something like a spread option without losing your time value. Whether it could be on the buy and sell, that's possible, or you can go for a sell buy, whichever thing that you do is, you can do that and probably get a much fantastic return when compared to the futures. So you will have definitely an arbitrage of capital. Arbitrage of capital that will be there. So you tend to go for a much lower capital to get a much higher reward. So this is the type of trade which we are suggesting, and today we explained with example of that the margin money requirement which is being imposed right now should not scare you as far as trading is concerned. Options, in the normal options for intraday itself provides a solution, and the spread option provides a solution for position trading without sacrificing anything, without sacrificing the possible reward like a futures. With much lower capital, you can do the trade. So what we need to concentrate is not on the capital side, but more focus on how we can enhance our trading ability as far as the market is concerned. Okay. So right now 7:45. With that, I leave it to you for question and answer session. Thank you. Okay, sure. Next Monday we will have in Tamil. Okay, I agree. So we will have session in Tamil, one or two session in Tamil. The same thing we will have next week. Thanks for your feedback. Thank you for participating. Please attend on Friday again. We will give you the idea of what we should do as far as Nifty is concerned, Bank Nifty is concerned, and even some stocks. Okay. Thank you very much.